If you're watching this video, then the chances are you're saving a deposit for your first purchase, and it might come at some point this year. Now, I was going to say saving is the most exciting part, but let's be honest, who's excited about saving for the next 48 months for a deposit for a house that you may or may not be able to afford at some point in the future? So to save all of that, I'm going to give you some little tips on the best ways to save. Hi, I'm Sam Fox, a mortgage expert in the UK. Welcome to my YouTube channel. Here I'm going to break down everything from mortgages, fixed deals, tracker deals, the best lenders, new schemes that come to market, you name it, I'm going to break it down for you. So do me a favor, hit like and subscribe. You'll do wonders for the channel and you'll help us reach our targets this year. Right, with that out of the way, let's get to it. So first things first, where the hell do you start when deciding on a deposit? Well, commonly you're going to need between a 5% and a 10% deposit of the purchase price as a minimum. Now, yeah, there are some schemes that might allow a lower deposit, like $5,000 or $3,000 or something, and some might even do 100% loan to value. But if you do have some form of deposit, ultimately it's going to mean a lower interest rate, which means it's less charge against the money you borrow, meaning each month it's going to be less for you. So try and save as much as you can. The larger deposits mean a lower loan to value, like I mentioned there, and that means if you buy in 5% brackets, it's going to mean you get a better interest rate. So you've got 5%, 10%, 15%, 20%, all the way down to a 40% deposit is where you get the market leading interest rates. Now, it's ideal. Not every first time buyer can save 40% of the purchase price. In fact, I don't think in 10 years I've ever come across, I've ever come across a first-time buyer that's had that much of a deposit. So 5 to 10% is exactly where you need to be. One final point on there is look at Rightmove. So look at the areas you want to buy, look at the potential houses you want to purchase, and then work that backwards. So let's say, for example, you'd like to buy somewhere £250,000 because, you know, it's a 3-bed, it's got a drive, it's got a decent sized garden, then you're going to be looking anywhere up to £25,000 if you need a 10% deposit. Once we've got that figure, we can look at your income, reverse engineer it, and it gives you that figure. So the second is build a savings plan. Now, age-old saying, fail to prepare, prepare to fail, and all that kind of thing. But it is true, you need to decide on how much realistically you can set aside each month and calculate how long that's going to take to get to your target. If you're in the position where you're living at home and you can save £1,500 a month, amazing. You might be there within 12, 18 months. But if you're currently renting at the moment and it's going to take you a little bit longer, we need to factor that in. So even if it's £250 or £500 a month that you can save, we need to understand how long it's going to take you to get towards your goal and what ways we can use to boost that. A great way to look at it is to use automatic transfers. Now, most challenger banks, and well, even more traditional banks now, you can do the automatic payment setup. So if you go into a shop, you make a payment on Apple Pay and it's say £2.50, then you can double up to the nearest pound. So you might save 50p to get to £3, but then you might be able to set it to £5. So every purchase you make regardless is a minimum of £5 and the rest of it goes into a savings pot. This is an easy way to chuck an extra 10, 20 quid a week here. The other way is standing orders. Well, that's probably the most traditional way, is set up a standing order into an account each month that's going to earn you some interest. You also need to look at how long you're going to wait to use that money as well, because that might determine how you build that savings plan. So for example, if you have a cash ISA that you can access every single month, you transfer your money in, it's easy to get it back out. But there are savings accounts where you might get a better rate of interest if you lock it in for say 12 months, 2 years, 3 years, sometimes even 5 years. So if you know it's going to take you at least 5 years based on your current income and expenditure, you might want to be transferring your money straight into that account, forget about it for the 5 years, and know by the end of that period of time, you're going to have an amount of money saved up. What I would say though is, if you're using cash savings, don't do what I used to do. Payday comes along, transfer £1,500, amazing. Week 1 goes by, you pull out £200 again because you need to go out with your mates. Week 2 goes by, you pull £300 out because there's something you need to buy, so on and so forth. So at the end of the month, you've actually saved £250, even though on that payday you're spending £1,500. You think, yes, it's amazing, I'm getting closer to my savings goal. You're actually backtracking. So I know it can be tempting and you might want to put as much as you physically can in, but you start getting into the habit of withdrawing money ad hoc if it's stuck in a cash savings account. So let's be strict, set up the payment plan, set up how long it's going to save, and get them payments in there and just forget about them. The third thing would be to choose the right savings account. Now, like I was saying in the last point, if you're going to save over several years, consider the accounts with higher interest rates and tie-in periods, not just the instant access ones with the lowest rates of interest. Now, a great way to start this is you can use comparison websites to find the best deals and solutions. They might throw up lenders you've never even heard of, where they're trying to raise as much money as possible, but offering the best saving rates available. So we need to make sure that you're going to be comfortable with those sorts of companies, how long the tie-in periods are, and how much interest you're going to be getting from them. So as a first-time buyer, the next thing I'm going to say is you can look at tax-efficient schemes, such as the lifetime ISA, which, by the way, we've got a video. We'll drop it here so you can watch it afterwards as well, and we'll put it in the comments so you can watch it once you've watched this whole video, hopefully, and you've liked and subscribed. But for first-time buyers, and many of you buying houses, lifetime ISAs can be great because what happens is you can boost your savings with up to 25% contributions on your money each year. Now, there are contribution caps, age eligibility, minimum saving periods before you can use it towards your house purchase, and there are sometimes property price limits as well. But you can open a standard savings account and the bonus and the tax benefits might make a huge difference towards your saving goals. So if you save £4,000 a year and the government are going to give you £1,000, what a great boost that is. And if you do that over a number of years, you can just think of all the savings and bonuses you're going to receive. So on to number 5 is to know the eligibility and the criteria. So with bonus schemes, you must be eligible. So we're talking here, you've got to be a first-time buyer status, property conditions, that kind of thing. You need to know the withdrawals from them as well. So if it's a non-qualifying reason why you're withdrawing your money, there may be penalties incurred, which is going to suck because we're trying to save as much money as possible. And if your purchase timeline shifts and the property price increases, that can also affect the routes that you go for savings as well. The 6th thing I'd say is combine strategies and stay flexible. So use a blend, use regular savings accounts that are easy to access money, use bonus schemes like the LISA for the extra boost, and set up automatic standing orders. Review the savings plans regularly because property prices might change, house prices and interest rates are going to change and fluctuate. So by the time you come to purchase a house, your target might need to be adjusted, you might need more, you might have oversaved and you can buy a few extra things when you're in the house. But it's also important to understand that affordability isn't a target, it's an assessment of what can be affordable. So if you've got a mortgage broker or a bank saying you can lend £500,000, it's not to say you should absolutely run out and try and get a £500,000 loan, which you can do if you want to, but it might mean that your savings are going to be delayed or the timeline of you buying a house are going to be delayed. There's nothing wrong with buying something smaller and working your way up to it over the next couple of years to buy something bigger. So there you have it. There's some little tips and tricks when it comes to saving for your first house this year. Now, if there's anything I've missed off or if you've got any suggestions that other first-time buyers might look at and take note of, please leave them in the comments below. I'll be here to answer them as soon as they're on there. And if you need any further information, please drop me an email. It's sam@ukmc.co.uk. I'll see you soon.